All right, welcome everybody to day 4 of the 2026 TraderLion conference. The first 3 days have been fantastic. Hopefully you guys have learned a ton. And let me know actually in the chat right now, who has been your favorite presenter or favorite concept that you've learned so far this year. For me, there's been an absolute ton. And I look forward to rewatching all the replays once we've got everything ready. So again, let us know your favorite so far down below in the chat or comments. Let's dive into day 4. So first things first, again, we keep this 100% free. Our ask from you in return is to help us share this resource that we're building. And, there's a unique chance to learn from market wizards, top traders. So if you would do us a favor, help, let other traders know about this. You can share about the conference on Twitter. We'd really appreciate it. And you can scan this QR code to do just that. All right, so here's the conference for the day 4 of the 2026 TraderLion conference. First things first, we'll have an excellent presentation from Mark Ritchie, Brandon Hedgpath, and Bob Weissman going over some case studies and trades of trading VCPs and how they actually approach entry tactics and position management of these key names. So that's going to be fantastic, going through some, nuts and bolts of how they actually trade. That will be very, very good. Then we've got market wizard Chris Camillo coming up at 11:15 around then, discussing the next waves of AI investing. Chris has a very different approach than a lot of the traders at this conference, but it's something, very important that a lot of us can learn from. So very complementary to what we're doing with technical analysis and finding setups. He thinks more big picture, and this should be an absolute excellent talk as well. And I always learn something new when I talk to Chris, so definitely stay tuned for that. Huge thank you to our sponsors, as always, DeepView, TraderLion, and the Trade Lab. Diving in, we've got the summer sale over at deepview.com. We've got a special annual deal going on. This is obviously, my one-stop shop for screening, charting, dashboards, you name it, we've got it. Definitely check it out if you haven't already. And we're always adding features and making this more powerful. And I highly recommend checking this out if you haven't already. Then I also want to mention the TraderLion University summer sale. You can use code SUMMER for 25% off any masterclass that you'd like. We've got excellent classes from John Boyk, Jared Tendler, the Lifecycle Trade Team, Oliver Kell, Stan Weinstein, and more. Leif Sarade, Pradeep Bande. Many of you guys loved his presentation the first weekend. If you want to take his episodic pivot masterclass, you can also use this code for that. And the link to visit is traderlion.com/university. And again, the code for 25% off is code SUMMER. These are fantastic. Each one, we work incredibly hard to compress knowledge and make the best resource possible. And each of these has really helped me accelerate my learning curve, even as I'm helping create those resources. If you haven't taken any classes so far, I'd highly recommend starting with the Oliver Kell Swing Trader Masterclass. Even if you're a position trader, CAN/SLIM trader, this will add to your arsenal of knowledge. So again, highly recommend all of these in the chat. I know many of you guys have already taken our classes. Let people know, what you thought of them. What were your favorites? If you've taken the Oliver Kell Swing Trader Masterclass, what do you think about it? Would you recommend it to other traders? I'd highly recommend, again, checking all of these out. All right, I also want to mention the Trade Lab. So the Trade Lab is my educational service where I put out a daily market report every single day, but it's much more than just market analysis and a daily watch list. There's also a lot of built-in resources that help you develop your system from the Trade Lab Bootcamp that extensively goes through each aspect of building a trading system, writing your trading rules. We've also got the Building a System course, and we've got the case study webinars. The next one will be very shortly on SNDK, and each of those case studies dives into a market leader from the past and distills the characteristics that made it stand out, and talks about how you could trade it in real time, and how you can apply these principles to capturing future market leaders in future market cycles. So if you haven't already, definitely check out the Trade Lab. And if you're interested at all in a special deal, email me at richard@traderlion.com and mention Trade Lab conference deal, and I'll let you know the details for that. All right, so I know I'll get this question today. Will it be recorded? Yes. This stream is actually already watchable on this URL. You can scroll back in time at any point. And in the future, you can also just come back to this URL and it'll be viewable on our channel, and scroll back and go back to any presentation you want, and we'll be adding timestamps so you can jump back and forth between different presenters. It's also all stored on the conference resource that you've gotten through their VIP pass. It's 100% free, and you should have gotten emails about that, how to unlock it. But again, click the link down below in the description if you're interested in that conference resource. There we'll be storing the recordings ad-free, as well as guided notes and slides when we've got them. So definitely check that out if you haven't already. That's an excellent resource to really get the most out of this event. And speaking of how to get the most out of the experience, first and foremost, definitely get that VIP pass, get the conference resource that's linked down below. Also subscribe to the TraderLion channel. We do much more than the conference every single year. A lot of people find out about us by the conference, but we're posting regular webinars. We're posting podcasts with top traders and market wizards. So definitely subscribe if you haven't already. It's 100% free and can only help you in your trading journey. Also, as we go through today, I'd highly recommend engaging the chat with others and with the speakers. Share notes and key takeaways on X. I haven't seen that many, so I'm actually surprised. Are you guys taking notes? Hopefully you are, but feel free to share them. That's our goal here, is to create a resource, and you sharing your notes can help us in that goal. And then, like I said, you can rewatch your favorite presentations at the conference resource or on this URL at any time. All right. I also want to recommend the TraderLion University free resources. If you're just getting started, this is a great place to begin. We've got the ultimate screening guide. We've got historical bear market corrections. We've got model books, so much here. Just go to TraderLion University, create a free account, 100% free, and all these resources will be available to you. And you can also check out this QR code and get right to that link. As with each year, we try to do something really good for the whole world. In addition to this TraderLion conference, in the past we've partnered with some amazing charities, St. Jude's. This year it's a little bit more personal, at least for me. I decided to choose the Michael J. Fox Foundation for Parkinson's research this year. Earlier this year, unfortunately, my grandmother, Grandma Jackie, passed away from Parkinson's. And, she had been dealing with symptoms of Parkinson's for quite some time, dyskinesia. It affects not only the person who has the disease, but also the family and friends around them, and can be very devastating. So I'd really encourage you, if you found value so far in the conference, or you find value in the future of it, pay it forward with a donation towards Parkinson's research. We've already raised a fantastic amount. And again, if you haven't donated already, donate what you can. $10 is fantastic. Again, this is 100% free event that you get to learn from market wizards and top traders directly. This is something that's extremely valuable. And, if you are enjoying it and learning something new, which I'm sure you have, pay it forward again with a small donation. We'd really appreciate it. Even $10 is great. Here's a photo of my grandmother with my mom and my aunt right here. It's a really devastating disease, and your donation goes directly to the research to aid with treatments and management of this disease. Neither TraderLion or YouTube take any cut of the donations. It all goes directly to the foundation. And this is one of the most efficient foundations in the entire world. It's very highly rated. So definitely pay it forward if you haven't already. And a huge thank you in advance to everybody who has done so. One last reminder to subscribe to the TraderLion channel. Check down below the video right now. Are you subscribed? If not, what are you waiting for? It's 100% free. Again, we've got the TraderLion podcast, in-person interviews, tutorials. I'll be doing a lot more in-person interviews, by the way. Really looking forward to that. Free webinars, key clips. And our goal, long-term, is to help 1 million traders, build their systems, learn how to trade the right way, managing risk, all of that. But in the short term, we want to reach that 200K mark. So look down below. Again, are we there? If not, go ahead and subscribe. And a huge thank you in advance doing so. I put a ton of time into this channel, and you subscribing can help us reach our goals and help a ton of traders out there. So huge thank you in advance again for subscribing. And with that, thanks so much for tuning in to day 4. Should be fantastic. And I'll see you guys in just a bit. All right, welcome back, everybody. Joining us are three fantastic traders and educators. We have Mark Ritchie and Brandon Hedgpath, portfolio managers, as well as the directors of trading and education, respectively, at Minervini Private Access. And joining us also is Bob Weissman, the 2025 U.S. Investing Champion in the Money Manager Division, with a return of over 115%. And he's also the director of ops at MPA. So, Mark, Brandon, Bob, thank you so much for joining me. This should be an action-packed session. We're going to cover a bunch of trade case studies, talk through how you found them, entries, risk management, position sizing, and sell rules. So thanks so much for being here and for your time. Appreciate it.
Sure thing.
Of course. Yeah, awesome. Let's go ahead and start with STX. And Mark, Brandon, I know you guys operate as a team, but to start with, maybe a good place to start would be how this got on your radar. What kind of drew you to this idea in the first place? A lot of folks had questions about, finding trades. What are some of the criteria you look for? And let's start there with STX.
Yeah, so originally, Marky, you can fill into what I leave out, but STX was one that really kind of came off the April lows back there, Bob, if you want to show that, after the market bottomed, and really kind of never set up a right side. It just kind of, rallied strongly, and then it finally paused over the summer. And then you have, I think we actually tried it a couple times in here, a little bit to the left there in July, but then bought it on August 18th, where that green arrow is. We were tracking this as one we wanted to own, but it just never gave us a low risk entry point. So as you can see on Bob's chart, we have the behavior analytics is like what we like to call them, the Fab 5. So you can see that those stayed pretty strong, and RPR, relative strength, is something that we really pay attention to, especially when we're screening, because we want to be in the strongest names. So this was one that stayed strong, but again, never gave us an entry point. So on August 18th, we finally got that. So Bob,
that little pivot there. Yeah.
Yes, that three tight areas there, or those three tight bars. Marky, again, fill in anything.
Yeah, I mean, this one was just kind of classic in terms of going through the process of what we would, look at buying, mainly because it wasn't in a stage 2 uptrend. For those who aren't familiar with that, read Mark Minervini's book. We have, the trend stage indicator in terms of our platform, but this is really the first buyable base. Stock has this big run. And obviously what looks expensive to everybody else is attractive to us because, that's when, it wasn't ready for a low risk entry. Well, that's what requires patience and diligence and tracking it. And so, and to Brandon's point, you also had the classic example of the first one you got shook you out. Well, sometimes that sets up an even better setup. The base actually improved. Obviously most of us, if you've been paying attention to the market, most people sold this one too early. We caught it for a nice move.
Yeah, and actually, I think we made like just over $1 million on this trade alone. But Bob, could you zoom into that entry? Because I wanted to point out one other thing. Because we talk about supply drying up. Right before we bought was one of the lowest volume days in that whole base. So to Marky's point, this is just classic. So then we sold the first piece on 9.5 up 20%. And Marky, I don't know if you want to talk about that.
Yeah, I'll just add. I mean, look, Richard's an alum of the Master Trader program. He should be familiar with this is classic. There's nothing new here, nothing new that Mark hasn't been doing for 40 years and teaching about. And so it's wash, rinse, repeat. Obviously, you don't always get the follow through this strong and this perfect, but this is what a classic leader looks like.
And one question here, how important was the kind of theme and group that this stock was a part of? Because we had moves at the same time, MU and SNDK. How are you guys, did you guys take that into account, have the kind of sister stocks to that theme we're doing at the same point?
Yeah, Marky, you want to?
Listen, obviously you're always going to have some of the leaders either in related areas, and this was one, Western Digital and this both kind of set up at the same time.
Yeah.
Look, if they're both breaking on the same day, I'd buy them both. You just have to be cognizant of your concentration risk. But look, the stocks need a risk manager at all times. So you do have to be cognizant if trades are highly correlated. But I don't mind that when they're working. That's, you want that, if that's where the alpha is, that's where I want to be. So look, I don't think about over concentration risk in terms of related areas. I'm managing, risk in real time. So if we start feeling too much pressure, we're going to adjust, by reducing size in general.
And if I remember, yeah, Richard, to your point, like the data storage was really kind of hot, right? And I think STX was just kind of like the one that kind of set up the cleanest at that time that we bought. But either I think the other two were actually had a good move as well.
Yeah, they did. Yeah.
One of the things that we always talk about here at Intervening Private Access is we let the market tell us what to trade. We don't try to find. So as you refer to, looking at the sector, Rich, and then finding the stocks, it's actually the other way around. We're bottoms up. We're going to find whatever stocks are meeting Mark's criteria. And from there, it may turn out that there's a bunch of them in the memory space or, SanDisk, obviously, Micron as well. But ultimately, the stocks meeting the criteria that has been working throughout Mark's trading career. In fact, I could show you charts Jesse Livermore was trading 100 years ago that is using Mark's methodology perfectly then as it will 100 years from now, is to say we're going to find the stocks meeting that historical precedent of our leadership profile, and that's where we're going to look to trade, not because, memory or AI or energy is where all the money is going to.
Yep, makes sense. And Mark, you mentioned risk management there. That's actually one of the follow-up questions I had here. From your buy point, it kind of stagnated for a few days. What are your kind of mindset in the first few days of a trade when it doesn't quite push out just yet? And like you said, maybe it even almost improved the chart. It got a little bit more mature. But what's your guys' mindset after your buy point? If you remember exactly where your initial stop loss is or your point to get out from that entry point, if it kind of did start breaking down from this base setup?
Yeah, well, it's as simple as, once we start seeing violations or the stock, look, you hit a stop level, you just get out. It's that simple. But stocks still have to be allowed to fluctuate. And, memory serves me correct. And Bob, you could probably show with the measuring tool. I mean, I think we were small, mid-single digits in those, that pivot is improving.
It's like a 5% range. It's tight.
Yeah,
it's improving. It's getting you better.
Staying in the range, right? So as long as that pivot is tightening, and this is precisely where, where Bob's cursor is right there. If I didn't own it, I'd be buying it there. And if I don't have my full allocation, I'm bumping to that level. Or if things are going well, I'm going overweight.
Yep, exactly. And sizing was actually my next question. If you guys remember how you sized this, and a lot of folks just had questions in general, how you guys might decide sizing, whether that's, you buy a little bit at first, see if it works and add on, like you said, at that next spot. But do you guys remember kind of what size in percentage of your portfolio you went in with this name?
Yeah, it was about 7.5%.
It wasn't even that big a position. Yeah,
No.
Obviously, I wish we could say we had our whole portfolio in it. Everyone wants to say that you have everything in the biggest names, but memory serves me correct. At least this is a year ago. We didn't get very invested initially off that sort of V bottom because, precisely to Brandon's point, we didn't see a lot of bases yet. It wasn't until you started getting traction in a few names like this. But this would be the type of name where, the only reason we're smaller there is because we weren't doing well. But I look at this is where hindsight isn't nearly as valuable a teacher as what's happening right now. If I have a tight entry and I'm running racks, I can't miss. I'm coming in big right off the hop. If things aren't working, I'm definitely going to be more incremental. I'm going to start smaller. I'm going to build up slower. And it's you got to be in your own lane in terms of how is the traffic moving in your lane. If I'm flying, then it's stay on the gas, right? So, and that's, again, just classic in terms of, everything we preach and teach.
Yeah, one of the things I think that's important to add is how Mark earlier said, how to stay in the name or how to not get shaken out of it or, give it the time to let it breathe and before it makes its move is the fact that it didn't create any of what would be our violations. Mark's rules, violating his rules is what he's meaning by that. And without having any reason to sell, there's no reason to get out. Now, at some point, there might be a time stop, and it's certainly more than 5 days worth. But without having any reason to sell, that's the whole point. We want to stay in a name that's acting normal, as long as we can, only look to lighten up or even get out of a name once it starts acting abnormal. That is a buildup of violations of Mark's rules. We actually have that sort of built into our software here. I'm not showing it right now, but that is actually part of the nature of our charting, is having Mark's violations and confirmations built in these proprietary indicators, if you will, of his methodology.
And was the pivot for this one the Wednesday, August 13th high, or was it more that upside reversal day, Friday, August 15th, I guess? So yeah, through that prior red bars high, or through that last kind of range high, I guess.
I don't remember.
You can use either. You can be incremental.
Yeah.
This is exactly what I would encourage folks to do. That first reversal right there is a pullback buy, a valid pullback buy. You can start your position through that high. And then if the distance between the two is, 1%, 2%, 3%, that's where I would just be buying incrementally, as the stock is on the move. I'd much rather pay up to be right. It's like, look, who wouldn't pay up for a little assurance in life? Yep. So, but yet when the stock market, it's up 25 cents, I don't want to buy it. Like I completely think the opposite way. I'd much rather pay up 1% to be sure that the stock is free and clear and on the move.
Yeah, one thing you may remember yourself, Rich, since you've been to the Master Trader program, you've learned all this from Mark directly, is we're not looking for the lowest price, we're looking for the right price. And the right price is when you get more and more and more confirmations of meeting Mark's criteria, his rules. And that's why even, it doesn't matter where you're buying, to a certain extent, it's the perfect opportunity for that low risk, high reward opportunity. And, as simple as it is to buy and sell higher is sort of as simple as the concept is. Doesn't mean it's easy, but that is as simple as the concept is. Buy and sell higher, and we want to be buying at a low risk, high reward, asymmetrical risk reward dynamic, which is what Mark Minervini is famous for.
Yep, and this is a great example of the VTP characteristics. Like Brandon, you pointed out the volume dry up as it tightens there, and how even after that initial squat, it tightens up further and still lower than average volume through that next tight range. Perfect. Any thoughts on position management that you wanted to kind of double click on here? This had a beautiful trend. You guys, took your partials off. Any thoughts here?
I should just add the last piece. I think was all the way.
We wrote this for a long time.
Rented mule. Yeah.
Yep. So yeah, I mean, let's go back, Bob, a little bit. So like here's another thing that we've learned through what most people don't understand is Mark and I were subscribers to MPA for 10 years before we started to help out. And one of the things Mark talks about is selling into strength. So that first sell, I believe we sold a third of it out of our position there to lock in that 20% gain. That financed the risk. So now we had a free roll there. And we kind of just legged out little bit by little bit until we realized, like, okay, we had the smallest position left, and we said we were going to basically use a backstop, with a closable of the 50. And it just rolled the whole thing up. And again, that's one of the things that... And then it just becomes
a function of once you're, because even right there, I think we decided to ratchet it up again. At some point, we don't want to ride that all the way to the 50 if we've made enough. But that last... Anytime we're playing something for a bigger move, it's always paid for up front. So anyone who, I want to be really clear on this. It's not like, oh, look at these guys. They put on their full line, put their whole account and wrote it for... No, we're never doing that. Because... You have to reduce the volatility of your equity curve. And to me, performance is measured on return relative to risk. Everybody just wants to throw out the eye-popping return. They don't want to talk about the risk or, how many times you had to hit the Pepto-Bismol or the bottle in order to get that return, right? And this is where the only way to have your cake and eat it too is to use strength for selling. Even so, to Brandon's point, as that stock is getting more and more stretched, all right, give them some. Okay, give them a little more. And to Bob's point, we've got this coded in Monalert now where we can see historical extension levels. The stock is telling you statistically it's very stretched. Well, and we're multiples and multiples of our risk. All right, we'll leak them out a little more. And then at some point, everybody's got to be happy with the profit, and you use a backstop or an extended, as a stock if it goes somewhat parabolic, when it went into that earnings and got sort of what looks like, if we had a weekly, you could see where the trend then starts to go vertical. We're cinching up a backstop even further. Because now I know that inevitable pullback is I mean, you could probably measure right there about, I don't know, 40%. You know, it's getting to the point where the rocket has to come back down. Well, I don't want to ride that rocket all the way down, especially given how much we were up on the trade.
Yeah, it's knowing where you're at on the mountain as well.
Exactly.
Right?
That's what I was going to say. You can see how far this is getting now. Asymmetrical kind of move here. And with that extension, you certainly want to give back the 30-35% before you take profits. Now, as it gets closer and closer, one thing, but you probably would be looking at something that would be below this price action. And it looks like about where it was when they got out.
Yeah, excellent. Any last key takeaways on STX that you guys wanted to emphasize? But this is a great textbook trade. We're all good?
Yeah, I think that.
Yeah, so I think Vickers next.
Yeah.
Perfect. So walk me through, guys, again from the beginning. First, what kind of drew your attention to this name? And I think your buy was December 19th, coming out of this VCP base after that momentum move up on earnings and the like. So yeah, talk me through this. And Mark, Brandon, whoever wants to kick it off first.
Go ahead, Marky.
Well, I mean, this originally, was on our radar just because of that strength and that absolute, rip in terms of earnings and was potential power play, where the stock doubles in a short period of time and tightens up. But then, it got it tried to break out and failed there, and was that late in the year, and just needed a little bit more time, where sometimes those, the high tight flag power play then just morphs into a base. But that strength, you could see the whole time. There's no selling. That volume never, there was no real selling in there. So we're just looking, can we find, a pivot to get on board? And this wasn't really the best pivot. It was just kind of a paused pivot after you had 3 lower lows, which again, something, we look at where stocks are under accumulation after that 3rd or 4th lower low is usually where you're going to find some sign of stabilization. I can't remember if we didn't buy it there for a reason, and then we sort of bought the breakout of the pause pivot 2 days later, and it was just off to the races. Not as clean or classic of a right side, but again, I want to say this was, if it wasn't RPR 100, it was pretty. We can see
it's
right
98.
there.
Yeah.
98. So you're still in the top 2% strongest stocks within the market. Just classic in terms of sticking with the strength. And it was one of those trades that we all want. It puts you under very little pressure right away, which is the best indicator. That's the best indicator that you won't get in, until real time. Meaning when you buy a stock and it just comes charging out the gate, that's the first sign in my mind, at least, to say, hey, think about playing a portion of this for a bigger move. That's obviously if the price action continues to corroborate. And that's what happened here.
Yeah.
Yeah,
our
you have that
RPR,
second day
which
follow
is
through. Look at that.
our RPR, which is our relative performance ranking, is similar to that of a relative strength rating. So this is rating every stock against every other stock, not the indexes. And this is to, clear reflection of the leadership. So 98 relative performance ranking is to say it's in the top 2%. We go 1 to 100. And even though, as Marky is saying, the little gap up here, pause pivot, not at the perfect type of pivot setup that would be in our classic, but sure enough, proof is in the pudding, stock's moving higher, and then just sideways until it's ready for the next move. Volume is, again, not accelerating just yet. No reason to be getting out, nothing, no violations going on here, but a perfect entry, once again, just from the standpoint of clearing this whole previous price action. And I think you guys sold right into that first, that real accelerated rally. Part of it.
Yeah, correct. And this is one, so here's another example. We made, I don't know, $750 million on this one. And I only say that because this was a smaller position. And it's like, okay, we just showed you 2 stocks that accounted for a good, that's real money. So it's like, you don't need too many of these if you just position size them right and you get on them in the right spot where you can ride them and they really make your return. So yeah, we sold a piece of this on 1.2, and then a little bit more on 1.5.
Okay.
Yep. So when as it got, short-term extended. So back to back.
Okay.
Yep.
I
We got the first one, and then the next day we sold another piece.
Yep.
And then 225, we sold another piece. So we rolled it. Yep. There you go. You got all those in there. So again, because we had a cushion, we were able to hold into earnings, which gave us that, we they gave us the good reaction. And so, we got 1, 2, 3, 4, 5 days of follow through. We sold another piece. And it's like, again, going back to where are we at on this mountain, selling into strength like Marky described before. And then,
and because they de-risked, for one, I'm sure is why they weren't terribly panicked with the gap down here. And it didn't even come back even to the break-even level. So even though,
if memory serves me correct, that was one of those phantom gap opens.
it didn't stay down there very
It
long.
wasn't down there for more than a second kind of deal, But to Bob's point, though, when you've de-risked, you just, for people who don't understand this, like, look, pros use the strength for selling because it allows you to be able to not have to panic, on an open like that. And look, in any earnings, because I believe the expected volatility of the earnings was double digits, we're never going to hold a large position into something like that, or one where we don't have something banked. Well, in this case, to Bob's point, we knew we had all that in spades. So even if we'd had a really bad gap down, was going to turn into a losing. We did have a short gap down. But again, though, we had it paid for with profits up front.
And we had a plan going into that too as well, Richard. Go ahead.
Yeah, I was just going to ask, like, do you guys have a rule specifically or a guideline for other traders out there? How much profit cushion you need to have going into earnings to look to hold through, or at least a portion, right? You can always, like you did, de-risk so you can hold, a portion through that event, because it is binary. You can gap up, gap down. You don't know what's going to happen. But yeah, do you guys have a guideline there that you like to use?
well, ultimately you can use the options market to get what the market is, expecting. But that's as good as like knowing the odds on a football game. So I've seen teams that were favored by a touchdown lose by 2. So, it doesn't really matter, for reality results, but to the extent that you can have an expectation, where your profit is currently, what profit you already took off, what is your potential worst case scenario, so to speak. And as long as you're comfortable with that, everybody has a different risk tolerance. That's what you determine how much of a position sizing you want to remain open, and obviously adjust accordingly. That's kind of an individual decision. So it doesn't matter what Mark's answer is or Brandon's answer is or my answer is. You have to sleep comfortably at night on your pillow. We call it the pillow factor for just that reason. You got to sleep comfortably at night with the risk that you have exposed to the market.
Yeah, and if there's one rule, it's never hold an overweight position into an announcement like that, because you're guaranteed at some point to take a massive hit.
Yeah. How many times do you see, record earnings, record revenues? I think Broadcom would be a classic example just recently with AVGO that we actually did have. But we had this name and we de-risked into this rally right before the earnings debacle, even though it was record cash flow, record earnings, record revenues, and they upped their guidance for next year, but not good enough for what the market was expecting. And that's all that matters. And the market said, not good enough. And we took the remaining piece that we had off here, I think at a break even or thereabouts, but it's because we had taken profits off that even allowed us to hold into what ultimately became about a 15 or 16 or 18% gap.
But that trade just highlights almost to perfection, though, the value of using the strength for selling, even ahead of maybe it wasn't earnings, maybe it was a news announcement, something else. When you use that strength for selling, walk away with a winning trade. While the person who's greedy and goes, I got to hold for the whole thing, turned their profit into a loss.
Excellent. And a larger question folks had, because I know Mark and Brandon, you guys kind of operate as a team. I'd love to hear a little bit more about that dynamic. Do you both have kind of separate routines you do, each kind of present a few ideas each day and kind of, cross-pollinate ideas and kind of decide what's in focus, the next day, the next week? How do you guys decide which stocks to focus on of that group? Walk me through that dynamic and how you guys feel it really benefits you to work as kind of that partnership.
Go for it, Brando.
Okay. Yeah.
I saw the smile. Yeah.
Listen, we do the same work. So we're both running the same screens. We're both it's kind of like he compiles his list, I compile my list, and then that's the idea side of it, right? Yep. So each morning we come to the table with, hey, what are you looking at? What do you like? And then we talk about it. And then obviously on the positions we already own, it's more of how are things acting? Do you see anything you want to cut? Do I see any? It's like we always have a plan for something, whether that's what we're buying, what we're holding, what we're selling. And that's really all we're doing all day long is just, talking back and forth about different scenarios. And the risk we're carrying.
It's not as exciting. It's not as exciting as a lot of people would think. And there's almost no disagreement because we're cut from the same cloth.
Yeah.
Right. Like
we're
both students of, of the Master Trader program, Mark's books. Before there were books, we had it's like this idea of the low risk entry. That's what we're living and dying by. So we may not identify the exact same name at the same time. This is where, hey, teamwork makes the dream work. And multiple sets of eyes, you're less likely to see things fall through the cracks. There's a lot of ideas out there. There's a lot of creative ways to express low risk entries. But you do this long enough, your eye gets definitely keenly trained to looking at some of the same spots. And then in terms of, risk tolerance and those things, it's just a function of, math and what we're comfortable with.
Yeah. Excellent.
Well, I'll say too, Richard, it started out as I just came to the office with Mark before we even partners, and we didn't even know where this was going to go. It was more or less he was paying for the platform and I was paying for MarketSmith, and it was we just kind of collaborated. We were doing our own thing, but also just talking through it, trying to learn. And during those days, the platform was just an idea generation and then Q&A, and that was it. So it was kind of learning on the fly with Minervini.
Yeah,
and
that's a good point. We didn't have near the tools and bells and whistles and prefab screens, and it's a good point because people think oh, you guys just decided to partner up or whatever. It was no, it was a process like anything else, and realizing, hey, we have the same sort of values and vision for trading that we learned together because we're wandering around in the dark like anybody trying to figure this business out. Bob can, add
I'm laughing hearing the story. So for those that don't know, I've been with Mark for 22 years, and Mark and Brandon, as mentioned, came to our very first Master Trader program in 2010, 16 years ago. And, these guys were as green can be when I met them, if I remember, because I don't think, Mark, you barely even traded a stock. I know you have a background in futures and things of that nature, but stocks was very new for him. And, to share Brandon's story, who some may know, but some may not, is he literally sold his car to pay to come to the Master Trader program to get the education, knowing a car may help you today and get you around, but knowledge is what's going to stay with you forever and provide a lifetime of value. And nothing could be truer with these guys as far as what they were able to do when they did collectively get together after about 6 months or a year after coming to the workshop, pulling together about $100,000 and subsequently turning it into $20 million over the next 15 years. And after 10 years of being a paying client of Private Access is where Mark and I, had them come on board as part of the team officially and working, on the trading desk. So helping educate as well as, being a director of trading, because they had proven what their skill sets, learning from Mark Minervini, had allowed them to do. And needless to say, Brandon can buy many cars over and over now with the money that he invested in that education. So
look, I think it's a good point. So go ahead, Bob. Yeah. Finish your point. I want to add something.
But to see their maturation, like any parent, seeing a child kind of go from crawling to, walking to jog or run to sprint is sort of literally what you can. I've seen thousands of times over with the thousands of people who come through the process to learn Mark's methodology. But the ones who commit to it, the ones who stay with it, the ones who are focused on it, all seem to get to the same point of being successful with this methodology that, as alluded to earlier, wash, rinse, repeat, just do it over and over and over again, and position yourself for success over and over is what's going to lead to the long-term, success as a trader.
Yeah, I was just going to add, one of the main reasons I keep doing this is because I know what it feels like to be on the other side, where you wonder, can anyone do this? Can people learn this? Is it a gifting? Is it a special talent? Obviously, I was, from a trading family, and living proof that, it can, all this information, and it's clear, to be clear, all of Mark's work is based on 100+ years of history and studying thousands upon thousands of charts and examples and these past precedents. So, and now, 16-ish years later, I can honestly, absolutely say unequivocally, it's doable. It's learnable. There's a lot of things you have to learn. And then there's a lot of things you got to internalize all the stuff so that you can actually act on these things in real time. But it's absolutely doable.
Well, I'll just add too, Richard, like, Mark was just as broke as I was when we went to that thing. We actually we couldn't even afford to stay the last night at the hotel. We stayed at a Days Inn in downtown Myrtle Beach, which was pretty scary. Yeah. And it's just like, listen, if we can do it, we really believe that if you're willing to do the hard steps, what a lot of people miss is they don't do the work themselves. And that's what Mark and I did for 10 years, along with Mark's teaching, just kind of checking. And a lot of the times it was more of a reflection of like, man, do we feel like we know more than we did a year ago? And would it be foolish to give up or to keep going? And it was always this idea of like, well, given the knowledge we know, we don't have the returns we want, but eventually they showed up.
There's that classic cartoon of the miner who walks away. He's like chipping away, and he turns back right before that thin wall is going to release the diamonds or gold or whatever that. So that embodies that perfectly.
The next trade I think I did have up here, which was the FLNC.
Yep, let's jump to that.
Yeah.
Cool. And this is a little bit different because we've got a little bit more of a pullback by type opportunity here. So talk us through, this variation of maybe an entry. Like you said, Mark, there's many different variations of low risk entries, and this is just kind of expressed a little bit more in a pullback setup than a pivot buy.
Yeah, exactly. I mean, look, you really had kind of you shouldn't say that low cheat right there is, not something I would normally play because it's sort of riding the 50 like that. But this was a pretty, again, a high RPR. I want to say 99, 100. But it was under pressure right there. You can see see where Bob, move your cursor one bit left there, Bob. Yeah, exactly. How he's showing, the stock is still under pressure. And I'll sometimes bottom fish or bottom pick really high RPR situations off of a pivot like that. But when it rides the 50, I want some type of confirmation. Well, it came out strongly. And then, of course, I'm sitting there going, oh, shoot, I missed it, right? Well, now what do I need to see to get back on board? Well, we had a sort of 1, 2, 3 pull back on lower volume, pull back by right to that little cheat spot, and then an inside day. That's where my antenna goes up to go. This is a type of situation where I'm either right on the money. I'm going to hit it right on the screws, or I'm getting out. Because that momentum is so strong, this is where it should find support and fast. Obviously we're reviewing winners here. We pretty much all our losers look the same. It doesn't work within 1 to 5 days. Max probably 5 to 10. We're gone. And this turned right up and then broke out. I think we added a little bit on the follow-up day. And this is an example of everything was looking great prior to our earnings conversation. You can see we just sort of leaked some out into the strength, and then the earnings came out, and the thing got torpedoed, and we sold our last piece. I think it was either right on that gap down, or I can't remember. We had some type of backstop that I'm sure it went through, but again, we sort of paid for that. But I don't even remember, Brandon, if you recall, this is one of those where implied vol was high and the gap was worse, and we just on that last piece just said get out. So we don't always sell absolutely perfectly, and in hindsight you can say, well, why didn't you sell it all? Well, we don't have a crystal ball. We trade manage risk in real time like everybody else, so we de-risked as much as we could into that, and then gave back what we did on that last piece.
Well, I would say you did sell perfectly, because once it hit your stop, you're out, right? And that is a perfect sell.
Well, meaning, but you know how it is, Bob. Everybody loves to show that they never
that's
took
what we want to share
on any trade. But
everybody wants to be perfect. Selling is at the absolute high tick of a trade, and
good point.
Good point. As good as anybody. Nobody can do it, and if you did do it, it was almost blind luck, because you'll never do it again. But the idea is look at the strength into it, and as Mark says, why are you such a fan of selling into strength? And I will tell you, even though I worked side by side with Mark Minervini for 22 years, it took me probably 3 years to understand selling industry. It was that difficult for me to process. And Mind you, I've been trading for 38 years total. So 16 BM before Mark, 22 AM after Mark. It is night and day, the difference of having a clear set of rules that you follow with discipline versus doing good and good at times, but also bad at times, and really just realizing you're flying by the seat of your pants. And the thing that, really made it clear for me, and I'll try to explain it in the same way, is your equity curve as your stock is going up is only going up, right? Up and to the right, up and to the right. That's what you want your equity curve. And ideally, not some type of roller coaster where you might get up higher, but you had to go through this first to get to that higher point. And that's where people miss the point. And Mark made the comment before, your return against your risk is what is most relevant. And so your equity curve is going up to the right. And even though you sold it, it's still going higher. Your equity curve is still going up and to the right. And here, let's just say, and I won't go forward here, but let's just say it goes all the way up to 50 after this. Well, that's not really worth having your equity curve look like that roller coaster to get up there, because you could just find the next new opportunity, which we always are going to have more opportunities. And it might be a new setup that looks like this, where you have a asymmetrical risk reward dynamic of a low risk with a high reward. And that equity curve will continue just going up and to the right. And that's what people seem to fail. They all want to be heroes of picking the exact highs and having the 100% winner. That's not how Mark Minervini made his deck of millions. It's because he sells into strength long before it typically will ever, top out. But as he's famous for saying, he buys stocks that go to zero and he sells stocks that go to 1 million. It's nobody's going to know. And as Marky just referenced, every stock we buy is going to meet our criteria, what it looks like. And just like snowflakes, no two are exactly alike, but they're very, very similar looking. And the idea, though, is what becomes a winner, what becomes a loser is the roll of the dice. Nobody knows exactly why one works and one doesn't. And that's why even to this day, if you're 50-50, that's all you want to be shooting for. But the ones that do work, we're looking to make that $2 of profit for every $1 we lost, 2-to-1 traders. And that is the, holy grail, if you will, of profitable trading, is doubling your average wins versus your average loss.
Yeah, excellent. Any last points on this? Because I know we got a few more to go through. So any last key takeaways from FLNC? We're good to go. I think MOD is the next one. And this is also a more pullback type entry, I think. Yeah. Yeah, so maybe Brandon starts off on this one. Walk us through.
Yeah, so we bought this one on 4.7, and we actually added to it incrementally on that gap. And again, this was coming out of, I think, what was the news that in the market?
This was the follow-through day, if memory serves me correct.
Yeah. Was it the
right off the
tweet or something like that?
The
tweet or something like that.
Something to do with the end of the war.
Yeah. Again, it was just like, to Marky's point, it was the follow-through day, and you don't know that ahead of time, but obviously you can tell through the action of what's happening on your watch list of the strength. And so we added to it incrementally. We didn't pay up a lot for it. However, we were going to be tight on that add. Well, we got follow-through. So again, like to Bob's point, look again the volume. Look at how dry the volume is on that pullback. Right? And again, look at the RPR, the Fab 5 as we like to call them. It's got everything we're looking for. Okay? So now, Bob, go ahead and zoom out. As you can see, we got pretty good follow through. We did get a pullback, a natural reaction that lasted a little bit of time, and we sat through that. And typically what Mark and I like to do is, as the stock's working in our favor, we want to try and, give it the benefit of the doubt and hold through the first natural reaction to see if we own a tennis ball or an egg. Right? Now, if we're up 15 to 20%, we're not going to let that come all the way back to even. We're going to try and sell a piece into that, because that just gives us the ability to hold into a pullback without sweating too much. Well, this one continued to follow through, and we sold the first piece there on 514, which gave us the ability then to sit through a bigger correction and hold through earnings. And then as we got that earnings gap, right, so as you can see, we sat through 2 natural reactions, and we had the earnings come out. And then on that gap, we sold another piece and then decided to punt it the next day. So 526 we sold.
Yeah, I think we backstopped the remainder, basically saying this is getting a little more aberrant in the price action, and we'll sort of take the gift, if you will, on the earnings. And we had a backstop that was nearly hit prior, just below the 50 as well. So it was kind of one of those, hey, let's
bailed out. And I think, Marky, what we did was we backstopped that gap day.
That's
so
right.
it was it was like, hey, if this wants to continue to go, fine, it'll keep us in it, but let's not give it the
So
low
through
of
that
day.
low.
Yeah,
that
that's
low,
another
basically.
really good tactic that's very subtle that, again, we learned on the MBA platform of this idea, because sometimes, let's say you're happy with a profit, you know, maybe you were at 2 times your risk the day before, stocks gapping up on news, and what is the over-anxious trader just sells it. Nothing wrong with that, by the way, if you're at a multiple of your risk. Taking profits is a good thing. But you know, the use of the backstop as a form of selling, where you can sometimes, you know, sit right below, you know, where the market's trading, going, I'll let the momentum take me out and then just kind of trail it up. Now, we don't use a resting trailing stop. I know some traders who do. That's fine too. But it's that idea of, you'd be surprised if that gap had just gone, you know, which is how we handled, say, the situation of Micron earlier this year. You just keep ratcheting up your backstop, and then as the momentum finally wanes or turns down, it takes you out. But that's that's in profit protection management mode when you're well extended from your buy point and you already know you're going to take the profit. That's where we like to use that tactic.
Yeah, something to note. So here before the earnings, of course, it could have been just as much down, but they were still at a 20% profit from their purchase. They already de-risked the part of the trade. So, and after the natural reaction, they probably had their break even moved up, or the stop loss rather, to the low of the natural reaction. So as mentioned, got close to it, but didn't actually touch it. And then certainly when you get the gap, you know, off the earnings, you're going to definitely take some more off the table. And then, you know, once, as I think statistically speaking, about 50% of gaps fill, the other 50 don't, but, you know, a classic backfill of the gap, and that's where you just got to take the risk.
One thing that stands out for me, before you jump to the other one, Bob, if you go back to the mod for just a second, this and Vicker both had a little bit of a similar larger setup where you've got a pretty big base, a momentum move out of that base, and then you had the consolidation that set up that then you guys traded. So Vicker had, you know, a larger pattern, kind of from September to here, gap up, strong push higher, and then it calmed down, tightened on the 50 as you guys bought it. And Vicker Mod kind of shared that aspect. But yeah, sorry. So let's jump to Emmy. You just wanted to add that point.
Well, that's a good point, Richard, though, because I think, look, this is the whole reason why you don't have to chase. I do not understand this. I mean, I understand it, but this need, everybody wants to chase whatever's moving, versus just wait for it. You know, I think it was Bob was, you know, quoting Mark Minervini saying, we don't want the high price, we want the right price. The right price is when the stock has gone through that proper VCP characteristic where strong and weak hands are changing, and you can then align yourself and to know, and the way I like to define the low risk entry is so I can know in relatively short order if I'm right or wrong. That's what I want. I want efficiency on my capital. I don't want to have to wait around for weeks and months. And what do you always hear when the stock's going down? Then you'll hear all the fundamental stories about how great it is. If it's so great, why isn't the price moving in your direction? Well, I'm willing to wait for that price point, even if I'm wrong, because then I can quickly move my capital to somewhere else. And that may sound, you know, crazy, but this is precisely how you can compound returns very quickly if you do the work right.
Somebody might say, why not buy it just on the gap as it's clearing the whole base here right at that point? Because this gap is about 12 or 13%. As we just said, half the time gaps are going to fill. So could you hold through a 13% pullback and fill that gap before it might do this? No, that's not a risk that Mark Minervini is willing to take, and there's where you just got to let it go, and that's okay. Sometimes they will go and they'll go straight up for 1,000%. Doesn't matter. But the ones that do come back and meet our criteria and set up properly, that's where we have a low risk, high reward entry point. That's where we have the benefit of that sort of, we can lean on that, again, historical precedence of knowing what we're looking for to meet Mark's criteria.
And
Micron's a good example, though, where it did gap, but that was a reasonable gap. That was only about, 3 or 4%, if I'm not mistaken, and coming right out through the pivot, as you can see, clearing all this price action behind here, which is as textbook as an entry would be if it didn't have the gap. And sure enough, we took that profit, or you guys took the profit fairly quickly in this trade, just as again, learning from Mark Minervini, you were up here already a good 15% or so, I guess.
Yep.
Yep.
Partial profit. Yep.
Yeah, we
You
had, I
know,
think we had an
yeah.
overweight on, and that's what we sort of
Yep.
reduced there.
Six trading
it's-
days?
Again, it's same tactics. Just another example. This is where, as the stock then started gapping, I think it was that 3 days prior to that one, the first gap there, right? We were thinking we were going to take a profit there, or at least sell a little more. But we sort of used that gap and said, all right, well, we'll use a backstop at the low. Well, then the next day and the next day, and then we gapped it, and then we used it again that day and sort of cinched it up intraday, going, all right, this is going into the nosebleed section. We're happy to
800
Yeah,
from
exactly.
470 in 3 weeks.
Exactly. And you'll hear people on different places, oh, you guys screwed up. You didn't. It's like, screwed up. Oh, we made whatever it was 60%, and
Yeah.
I don't know. Brandon's probably got the dollar amount. A lot of money.
Yeah,
in
it was
very
almost $1 million.
short-
Yeah.
Yeah, very short period of time, and didn't have to give, to Bob's prior point about the equity curve and using strength for selling, didn't give back almost a penny of that move. Because once you get that stretched, Richard, as you know, that 15-20% pullback is a lock at some point, especially in a name like Micron.
So that equity curve would have to go through this before it might go higher. And even though it did go higher, you don't know it's going higher. Everybody's a genius after the fact. But your equity curve took a 20% correction here and incredibly extended from the 50-day, even though it does, of course, go on to be going through the next level higher, and probably it'll go higher again.
And if it rebases, we'll get back involved.
Yeah, and more importantly, how many other trades have you been able to get into, Marky and Brandon, since you got out of this, and you went through this, you avoided this 20%, you might have missed that, but you avoided this 20%. How many other opportunities did you get into with a low risk, high reward opportunity, right? And then I think we also just quickly can show ARM, because another one, I don't know if I marked this one up.
Yeah.
It was May 13th, I believe.
Yeah, I was going to say, I have it right here.
Just a little bit before that, actually. It pushed up, pulled back in, tightened again, re-went. And then this is just exactly when you want to see a breakout. After it pulled back in and burst out, I mean, this is a great one.
Just classic.
And this is also coming out of a big base, right? Is that that's got to be one of the characteristics you guys look for, like all-time high breakout, base above that, and then you've got kind of a blue skies ahead if it actually pushes out.
Yeah, that's a good point. One of the criterias for power plays is it coming out of a period of dormancy, or I like to see sometimes if you looked at a weekly, to Richard's point, this stock had been in sort of a wide loose base for a number of years, and that power took it to new all-time highs. When a stock makes a new all-time high, again, this is right out of the pages of the Master Trader program, that gets my attention. But we don't just buy it there. Now we got to look for some type of low risk spot to get on board. In this case, it was a little bit wonky in terms of the pivot there. But our thought was, and we did not put on a big position. Full disclosure, it was quite small, and we were hoping. This is where I think the market was getting a little squirrely here too. But I was expecting, if this strength is going to remain, I think the stock's going to quickly move into new high ground. So we were just buying that first. I think it was after, again, sort of 3 lower lows, following that pullback from new highs.
I was going to say, you could easily have looked at it at this point too, coming off of the cheat area of this prior base. But
I think it was an early turn there, Bob. You're right, because I remember looking at it. But yeah, it didn't quite meet the. That would be going. You can buy an early turn if it's a power play type or big base, and this was,
and
it
you
was
can
questionable.
see
But he's right.
Right here, look at the trend stage up top. When I move my mouse, it's going to boost it. But when you see the trend stage is red, and that's exactly the reason why it's not quite yet meeting the criteria that would make it in a pronounced uptrend like it is over at this point. And you can see the Fat 5 all green across the board. Exactly right.
One thing, that lower area there on March 25th, they had a news catalyst. Basically, they had their own AI chips created. So that got it on my radar there. And then it tightened up nicely in that spot there. This has been one of the best semis to focus on for sure. But I love the explosion coming out of the base that you guys got. I mean, talk about time value for money. That's like 60% in 4 days, whatever it is. Yeah, rinse and repeat.
Momentum
one
at its finest,
one of the things we have is a news count. So it just is showing you exactly where you do have news on. And if you're, you see the number here. So the news count on that day, you can see 18 versus only 9 or versus only 2. So clearly some day that has 18 news stories, it's something really significant going on. So that's one of the nice things about just having that round the chart so you can see something that's going on or what might be causing that. But did we have a sell date, guys?
Yep. So the first one we sold on 520, Bob, at
So,
17.75%.
Yeah, right.
We actually
So
sold only a quarter of the position here to finance the risk.
yeah. And then another.
And then we sold another 25% on 521.
So right. Day after day, yeah.
Yep. And then we punted on 522. So that last piece we sold that fleet, to your point, Richard, up over 40% in a matter of days. So
Yeah. And again, people could say, oh, well, why'd you sell it there? It's doing so well. You'll learn. Yeah, so I think that's really textbook examples of how, now we have trades that, of course, we recommend on the service. As part of the service, these are the trades that Mark, Ritchie, and Brandon are doing themselves with their own real money. But as far as trades that we do on the service, we do provide that as well. And for example, right now, we have these names currently. Now, of course, this is being recorded, Rich, and it's the middle of June here, June 15th, as we know. But ultimately, you can just see very quickly, these are names that we, where we bought them. And when we overlay, this FRST as an example, and I just bring up the S&P, which I like to see on top of it, you can see where the market topped there on June 2nd. This is also where Mark Minervini, tweeted that we shorted the SPY on this day, right at the absolute high before this very quick 8% kind of pullback on the SPY. That was when we were buying the stock. So you can see while the market's going through a correction, this stock is breaking out and moving higher. And this is classic example where, focus on the stocks. It doesn't really matter what the market's doing. The stocks are going to tell you what you need. And we're buying that on the day that the market, at the same day that we're shorting the market. Not to say that we had a big bearish conviction on the market. It was due to the fact that as much of the fact that we had a lot of long exposure. At the same time, Mark, who is throughout his career uncannily calls these tops in the market, and we shorted the QQQs just a day or two later as well. But ultimately, it's just to offset some of the long exposure that we had. And as you see with a lot of the names that we have, look what they're doing while the market's going through a correction. And this is classic textbook leadership profile of a stock while the market's going through an 8% correction, just going sideways and biding time. And when the market, the pressure comes off the market as aroused, so do these names. And that's what you're going to see. Look at this. While the market's going through a correction, this is actually inching higher. This is classic example of why we don't really focus on the indices. We don't really focus on what the market's doing other than to have some context. But the stocks, if you just had to focus on your stocks, it wouldn't matter what the market's doing. And these stocks prove it doesn't. It doesn't matter what the market's doing. And that's kind of one of the nice things to see, just how the setups are going to dance to their own tune.
Yeah, perfect. Do you want to jump to Iron? I think we've got time for just maybe one or two more.
Yeah.
And then this was back in 2025, I think, August 15.
Yeah. So one of the things that we talked about with the original STX trade was where all this whole AI data center trade really started in earnest right at the first week of August. This is where in 3 months of my 115% return last year, in the 3 months of August, September, October, I made 70, almost 80% of my gain. So 90 plus percentage points was in just 3 months. And it's a classic example where you don't have to be in the market every day, all the time. In fact, that's not how Mark Minervini won his U.S. investing championships. He was famously in cash for half the year in 1997 when he won with 155% return. But when the market becomes easy dollars, which these names did, certainly with these August, September, October runs, iron was one of my bigger ones. But just to be fair and to be transparent, what I was doing last year was not so much swing trading, which is what we do focus on primarily as Mark Minervini's methodology, but just to prove the timelessness of his, I was doing more short-term trading. My average hold time was about 4 to 5 days, but they work on all time frames. The setups are going to look identical, whether you're looking at a daily, an hourly, a 15-minute, a 5-minute, it doesn't matter. And that's kind of what the notion was here. Again, not necessarily, as it turns out, this theme was very popular and got very big with the AI, but I also do trade a little bit more thematic myself, just because I am very knowledgeable about the AI data center, Bitcoin kind of sector. So I do know these names. And for a long time, these names were doing very little of anything. But right here on the 15th was where, I got into this particular name. Nice, classic. And I'm buying this off of a first screening on the daily, but then buying typically on the intraday setup, just so it's clear, which is to say, I might have stops that aren't going to be off of the daily chart, but still commensurate with looking for that 2 to 1. As it turns out, phenomenal move in just a matter of for short-term trade for 4 or 5 days to get the 10, 12, 15% that I got in this particular name. That says that you couldn't go to Vegas and do any better. It was as classic as you get as far as right out, quick little pullback, but held to stop even on a daily basis, or would held to stop, and sure enough, following through. Wasn't willing to hold through the earnings, so unfortunately didn't get this part of the move, but did get enough of the move that for, again, my time perspective, that was perfect. And then the other one, NBIS, just comes to mind as a clear another name in this sector as well, with the benefit of what was, I did mark this one up properly. So in this one, I had traded it a little bit after this earnings event. As you can see, it wasn't ready. Then they had this huge announcement with the $20 billion contract with Microsoft, and that's what popped the stock significantly. As you can see, the news count popped to 14. And so in this kind of, really was a power play, but from 50 to 100, off the power play, again, using a smaller time frame, because this really, on a daily chart, we want to be trading a power plays perhaps as quickly as this was, but this is almost more of a, that bottom fishing pivot kind of concept, where you're just using the low of this setup day, taking the breakout, again, in just a matter of 4 or 5 days. I mean, you're making 15 points, 20 points, and, so 15, 20% in just 4 or 5 days. That is a proverbial grand slam for me as a short-term trader, and turning over my money. I'm not going to have the 60, 70% kind of wins that a swing trader can have when things are really doing well, because I'm turning my money over much more quickly and then getting that compounding benefit much more quickly. So that's kind of that.
Yeah. 2 observations on both iron and NBIS is, if you zoom out, you're buying those patterns right at the top of big bases. So this is like a year-long base. If you go to a weekly chart, and it gapped up on that news, pulled in right to that pivot level, and that's where you bought it. So on a weekly, you're buying like that hammer candle, if I'm looking at this right. It's usually a seed. Yeah.
Yeah.
Yep.
Yeah. I mean, again, that's exactly what we're looking for. We're looking for strength. We're looking for stocks that are obviously exciting the market to the point that they're taking this stock to an all-time high. That's one of the most classic examples of what's going to cause it to come onto our radar. And I'll go back to the iron one real quick, but that's exactly right. We're looking for big moves out of bases. That's the soundness of our methodology, even though you can certainly have, oops, let me just go to the weekly here.
Yeah, it's a little squished.
And you can see, just doing nothing, right?
Yep.
Doing nothing. And as a data miner, which is what this used to be, it was doing nothing then. You can look at Marathon, you can look at Blockchain Rai, you can all these names, but look where it became interesting, right here, right when it finally broke out of all this, cleared all this price action going back all the way 3 years. And that's too far back, it doesn't matter. So once it finally got interesting, has your nice breakout, comes back and sets up here right, look at that, right in the middle of August. And again, don't even need to see the daily to just see clearly what I'm looking for when you're screening. And sure enough, that August 15th date was just, a classic kind of setup and entry point for me once it got right here. And just to prove the point of the timelessness, of course, we all know SpaceX, which just IPO'd yesterday. And if you just look, maybe I'll go down to 2 minutes, but on its IPO day, which was, again, Friday, June 12th here, you can just see what is a classic textbook VCP right here. Just classic 1, 2, 3 contractions, nice pivot with relatively tight volume drying up relative to the morning. And even though this is on its IPO day, which is something we don't normally trade, I actually did trade this. And you can see just 1, 2, 3 candles, just 3 time periods, 3 time periods. You're making 2 Rs. The distance from here to here, this is 2 Rs, that distance. And if you held through the natural reaction, which I didn't, but if you did, you would have gotten it up to a nice 3 or 4 Rs, right after your next thrust up after your natural reaction. So as classic as a stock can be, whether you think it's overpriced or not or whatever, it's meeting the criteria. It has the same textbook setup and, very tradable, which I did. It even had another one today.
Go to a 10-minute,
actually. You can spot these things. Bob pings me all the time and goes, "Hey," he's spotting these on the 5-minute all on the regular.
Yeah.
So
I tweeted this out today too. So I was spotting the same thing right there. Exactly.
Well, and there you go. Well, you have the same teacher. Eventually, you have similar eyes, right? And
yep.
Yeah. And you can just see
it just shows, to Bob's point, that supply and demand doesn't know time frame. So it's. And there's a lot of lanes on this highway in terms of art and expression.
And look at the volume, on those 2 bars, those 2 big breakout bars, clearly, and obviously got all the way up to here before it reversed. But if you're taking it at 174 and change, you stop here at 172, $2, and you got $4. So there's 2 Rs right there. And if you didn't happen to sell there, you never got stopped out, never even came back to the breakout, but barely. And then you got certainly in the next 3 bars here, your 2 R trade. And then if you held through the natural reaction, you definitely made 3, if not 4 Rs. I mean, at no point are you under pressure or feeling pressure at this purchase. And that's the Mark Minervini way. You get into the profit right away, never under pressure. You hold through a natural reaction, and you're 1, 2, 3 punch.
Excellent. Well, this has been great getting to see kind of case studies, how you guys each kind of apply the methodology and add your own spin and twist to it. For each of you guys, maybe one last kind of lasting bit of advice for folks on applying the methodology, learning about trading, studying. Both Mark and Brandon, you guys mentioned, putting in the work. How did you guys actually put in the work after you went to the MTP and really wanted to focus and improve on this? So maybe one last bit of wisdom for folks watching this. And Brandon, not to put you on the spot, but do you want to go first?
Yeah, sure. Yeah, absolutely. Yeah. Listen, so it started out as after the first MTP, we went through the screening, right? Screening, find the setups. And then along with the platform, it was kind of like we were comparing our work to Mark's. So we did that for a long time, where it was like we were making trades. We weren't just piggybacking on the platform, even though the platform gives great ideas. Those are Mark's ideas. So it was kind of like we were constantly comparing our analysis to his. And as we did it long enough, we got better. And even to this day, Mark's been doing this now 43 years, and Mark and I have been doing it, 16. With this methodology, it's like we're getting better, and we got the best version of Mark today than we even had back then. And to Bob's point, with the tools and everything with the platform, I mean, the fact that it's the same price as it was back then, as it is today, versus today, and you get so much more. It's powerful, but there's something about when you make your own trades, right? You're making your own decisions. Your trading is telling you a lot about you, and it's really important that you go back and look to see what you did right, what you did wrong, and you got to correct the mistakes. And I think a lot of people miss that, especially beginners, because they don't want to look at it. But that is the most valuable information. You got to see what you're doing wrong, because we get questions and comments all the time like, well, I don't know why I'm struggling. It's like, well, did you go back and look what you're doing wrong? Well, I did everything but that. It's like, well, that's what you got to do. And I get it. And it's like, doing the hard work it's called that for a reason. It's because most people don't want to do that. So if you can do that, if you want to be successful at this, you have to do that. I highly encourage it. And, again, the platform has made it easier than ever to do that. And then, two, studying model book, from William O'Neill's book to Mark's books, just getting those VCP, patterns ingrained in your mind. Get your reps in, like Bob. And listen, if you think, Bob sold me on this a long time ago. Mark started with nothing, right? And Mark and I pretty much did the same thing. And we were told when we first started, that was in the 90s, no one can do that again. But we did it. And you know what? I'm more excited for the next 20 years than I have been for the last 20, because we're just getting better at this. So start putting in the work.
Yeah,
I
excellent.
don't think I can say it any better, but I'll just add that, look, the learning curve is as short as ever. But to Brandon's point, people's ability to internalize those things, it still takes time. You're still there, and all traders have to go through that, their own version of working through weaknesses in their own game, and the only way you're going to get there is by rolling up your sleeves and doing some work. And not paper trading, and getting in the ring, getting pushed around a little bit, feeling what it feels like to lose real money. But yeah, I would say get a coach, get accountable, and then do the work, because that's the only way we improve. So, but yeah, I guess my last parting word would be discipline in the end is what separates. So surround yourself with like-minded people too that have the same goals, and I think you'd be surprised how good the results can be.
Excellent. Bob, to finish us off.
Yeah. The thing I would say, again, with the benefit of having helped thousands of people come through this process, and what I've seen over those years is, the stock market is the greatest wealth creating mechanism ever invented by mankind. Nothing can make you more wealth unless you're a rock star or a professional athlete. Presumably, you're not one of those. So if that's the case, the stock market is it. And with that said, you don't need to reinvent the wheel. So many people have, unfortunately, an ego that they want to prove they can do this and themselves, they don't need help and things of that nature, where I would tell you just the opposite. You are going to do this yourself, but it doesn't mean you have to reinvent the wheel to do it. You have to learn, master, and as we say, internalize that information, get it ingrained in your brain. That's only half the process. So you still got to use it, execute it, apply it in a real world environment, all in real time. And that takes practice. And as Vince Lombardi famously said, it's perfect practice makes perfect, not just practice makes perfect. So you got to have the benefit of having, perhaps a mentor or a guide, a tutor who is going to show you, hold your hand through the process while you perfectly practice dozens and dozens and dozens of trades. But after you do it, 100 times, 200 times, 300 times, and you start getting this down, the competency and the skills, again, you will now have this for the rest of your life to use it, and you will and can do it all by yourself for the rest of your life. But you got to go through the learning curve to do it in the most expeditious and efficient process possible. Learn from somebody who's already achieving the success that you're looking to do. Of course, Mark Minervini, we feel, is the best one to choose from, but certainly there are others. But, with that said, Mark has broken down his process to a very learnable, coachable process, a set of rules, which is clearly proven with the fact of our members have been the winners of the U.S. Investing Championship beside yours truly, but 5 of the last 7 years have been our members. That's not a coincidence. That's not a random fact. That is just demonstrating, repeatable performance, repeatable results from multiple different people because of the simplicity of once you learn it and are competent with it, you'll have the benefit of it for the rest of your life. So, stick with it, stay committed, be focused, and live with passion.
Excellent. Well, great closing thoughts from all three of you. The synthesis there is do the work, put in the effort, and good things will happen over time. Mark, Brandon, Bob, thank you so much for your time. Really appreciate you guys sharing your knowledge and everything. If you guys enjoyed, please leave a like down below, subscribe to the channel, and we'll be right back. Cheers. Okay, welcome back, everybody. Joining us next is Chris Camillo, individual investor and market wizard, who is known for social arbitrage strategy. He's the host of the Dumb Money Contest podcast and has been one of the leading voices of the AI theme and how investors can ride the waves. So, Chris, first and foremost, thank you so much for taking the time. A pleasure to have you here.
Dude, happy to be here, as always, for retail investors any day.
Yeah. Awesome. We've got a lot to touch on today. I think we want to focus a lot on where we are within the AI waves, the skepticism around what's going on right now, and kind of what that next layer of the AI wave and that theme can be. So to start things off, maybe give us some context. Where do you think we are currently within the AI theme in terms of the waves that you've seen? You've talked about that a bunch of different podcasts. Where do you think we are right now?
I think we're still exceptionally early. I think when we think about AI generally, everything we've been experiencing and everything we are set to experience the next couple of years all kind of fall in the first stages of the AI super cycle, which is essentially the discovery of intelligence, right? Which is where we were 3 years ago with that Chat GPT moment. And we were all kind of racing as investors to figure out the best way to trade and take advantage of this moment in time. We quickly transitioned into the AI infrastructure kind of wave, which was probably the biggest thing that we've experienced in a very long time, where we have 15 to 20 names across the chip and cloud computing and energy.
Yep.
You know, infrastructure that have quite honestly captured the vast majority of market gains over the past 18 months, right? So if you look over the past 12 to 18 months, there are a very small number of names that have captured the bulk of that market movement. And I think that has led us to a place where investors are confused. It feels like we're in a bubble sometimes. Nothing seems to make sense. The market moves erratically on a daily and weekly basis. And I cannot recall a time in my life where over a period of months and years, investors have had so much confusion and there's been so much conflict in terms of where we are, where we're headed, what's real, what's not. Are we in a bubble? Are we not? Are we in a bubble, or are we in the biggest thing to ever happen to humankind, right? And
Right.
We're not, you're not nearly investing aggressive enough. I've spoken about this recently. I think we are on the precipice in the next few months, the next couple of years, of entering kind of the third wave of the AI super cycle, which is still early. This is all the first piece of it, which is the AI efficiency wave, which is where companies actually start to extract meaningful value out of artificial intelligence in terms of lifts in productivity, massive increases in efficiency, the ability to either operate as is at a much lower cost basis, or where I think we're headed, the ability to meaningfully grow without having to add significant expense and headcount. And we are going to see economies expand, but expand in such a way where companies are able to kind of capture more meaningful markets without the traditional CapEx that they would have to spend to get there. And my thought is that we're going to see a widening of the companies who are benefiting from artificial intelligence over the next few years. So rather than it be 15 or 20 names, I think we'll actually see hundreds of companies that will, maybe thousands of companies that are publicly listed that will meaningfully benefit. And if you're an investor and you're just trying to figure out generally, where does the market at large go over the next 3 to 5 years? I think the optimistic take would be that the AI efficiency wave just tends to lift economies in a macro sense in terms of companies being able to grow and grow with a lower cost basis. Now, that doesn't necessarily mean that companies are laying off, employees at scale across every industry sector. I think there will be some industry sectors where you generally start to see a tightening of labor because they want to operate more efficiently, and maybe they don't have as clear of a roadmap for how to apply AI to chase growth that's sitting in front of them. And that will be damaging for some employees across some sectors. But I think we will see a lot more of companies realizing, wow, an employee can do 3x the work, 5x the work, in some cases
Solve more
10x.
problems, do more work on projects.
Solving problems that weren't really economically feasible to solve before.
Right.
And I think companies see that and they think, let's chase those 10 initiatives. Let's chase those 5 initiatives that we didn't think were economically feasible, but today are economically feasible. And let's do that with our existing employee base, or potentially tweaking our employee base, or what I think is actually more likely, although not a lot of people are talking about this, expanding our employee base somewhat to chase those opportunities, because we kind of see where we can hit our margins and expand our margins, right? In this new world where the intelligence layer is maybe not immediately less expensive, but certainly you have an outlook 3 to 5 years where it will get meaningfully less expensive than the labor count would have cost you historically. So I think if you're an optimist, and I am, that is how I see this unfolding. Some companies will benefit more than others. It's hard to envision a scenario where that doesn't play out. I think the big question is, how long does it take to play out, and how many bumps in the road do we have, between now and when this kind of massive amount of productivity and massive amount of high efficiency growth hits macro markets? Will there be a multi-year period where companies just tend to be too conservative and they pull back, and there's an employment issue or an unemployment issue that potentially leads to a recession? That's certainly in the cards. And I don't think anybody can predict with accuracy whether or not we're going to experience that. And
Right.
and if so, how big it will be, how long it will last. I have confidence in where we'll ultimately end up, right? And so what I have less confidence in is the timeline and exactly how we get there. And, if I'm an investor right now, and I've been saying this, I'd be really careful when it comes to leverage right now. And I'm a big leverage guy, as you know. I love leverage. But I would just be careful in how you apply that leverage over what timelines, and trying to, really wrap your head around a timeline for what's going to happen in the market. I think a lot of us are fooling ourselves that we can do that in this type of volatile market, because it you might be right, and it really doesn't matter. Because I think perception rules right now, and any crack in the news flow that is a negative, any thesis that comes out from anyone with any degree of respect, even if they don't really deserve that respect, right? If they have attention, if they get eyeballs, and that's enough to shake the market temporarily. And we've seen that time and time again. Like, we almost know, we don't know what's going to take down this AI trade the next 90 days. We just know something's going to take it down. That's almost a guarantee at this point, right? Like, I don't know what it is, but it's good. You better be ready for it, because something is going to take down the AI trade temporarily, about every 30 to 90 days.
We've had the tariffs, Iran, all this stuff has come in and caused those corrections, along the way.
And the reason for that is we're dealing with subject matter that most investors just simply do not understand, whether they're institutional investors. And we've seen, this is just really astonishing. I've never seen the gap tighten so much between institutional investors, institutional research, and retail investors with retail research, right? And in some ways, retail investors, some portion of them were getting meaningfully smarter. I would say most retail investors, because we just have so many of them in the market right now, are emotional because they're new, relatively new. They haven't seen things like this before. And they tend to get shaken out pretty quick because they're generally levered more than they ever have been. And when you're a retail investor and you're levered, you're quick to pull the trigger when things turn the other way. So meanwhile, institutional investors are just simply acting more like retail investors than I've ever seen them before. They are chasing attention. They are chasing hype and perception. They're trying to get in front of retail investors, of what retail investors are going to do next, as opposed to having kind of their own independent, more long-term minded theses, and they're unwilling to kind of take the short-term risk to be wrong in the short term because of market fluctuations and be right in the long term. And historically, that's where your institutional funds, you've really counted on them to be, smart in that way and not get shaken out. I think with the algo trading, with hedging, with everything, everyone is trying to make money every day in the market and every week and every month. And that is a dangerous place to be. It really is a dangerous place to be, where you feel that you need to be up every week, every month. It's a very difficult thing to pull off. I've never known an investor to pull that off meaningfully over the long term. And it puts you in a position to make bad decisions, I think, right?
I want to call back to something you said, at the very beginning, looking at this current wave, the infrastructure wave. And I know you've been trading this, with the semiconductor memory names. BE, I know, has been a huge name for you, riding this infrastructure wave. How close is that to cresting, or do you think it has more legs, the kind of infrastructure segment of this AI theme? I don't know. Where do you think we are with still the second wave here?
I think infrastructure has a ways to go. I think if you look at how we believe AI will play out over the next 3 to 5 years, we are going to continue to thirst for more. Anytime we achieve more in terms of what the models can do on the frontier of these models, or what the compute can do, I think what we'll see is not, oh, great, we could do more with less now. It's more of like, wow, what can we possibly do now with this intelligence? And I think that will continue to kind of loop back and drive more thirst for more compute, for more solutions to more problems, to create new industries. Hey, listen, this is a bit of an unknown right now. I know we have Jevons paradox, which is kind of like the thesis behind a lot of what I'm saying. And we've seen this kind of happen over and over again, but not to this degree. Not happening this fast. So I think over the long term, I sit on the side that says no matter how much infrastructure we build out, I think I would place my bet on us being constrained over the next few years.
That would be a bottleneck for it, basically.
I think there's still going to be a bottleneck, because at any time we're able to clear that bottleneck in some way, I think new industries will pop up to create new bottlenecks, because intelligence as an industry is just too broad. It touches every facet of life. It touches every problem. As soon as, I'll challenge you to think, let's just talk about advertising, okay? This is something we all understand. I mean, advertising has obviously evolved over the past 70 years. And at the same time, it really hasn't changed all that much, right? But when we look at advertising and we look at new technology and how that's impacted advertising, right? Whether it was the birth of radio or television, the internet, when we actually had personalization for the first time. Personalization was probably one of the biggest game changers we've ever seen. Targeting, the whole concept of like individual targeting for advertising through digital media. When we're able to take those ads and actually take them away from, something like this that you're in front of for some part of the day, and put it on this, which was that Facebook moment, right? Remember that back in the 2000s? And all of a sudden that advertising became not only personalized, but became mobile and was essentially with you every minute of the waking day. That is what created some of the biggest companies in the world, like Meta. All right. Google as well, obviously, right? Google and Meta. And now we think about what could happen with advertising, just advertising alone, right? When AI actually knows everything about you because you entrust the AI, it's so powerful, that intelligence layer, that you need its assistance for every facet of your life. It knows what you're doing. It knows what you react to. It knows what what you need help with. When you combine that with the ability to deliver highly engaging, personalized, immersive advertising, that could be two-way engagement advertising, our brains can't fully comprehend what the future of ads look like. And so, I know there's a lot of Meta investors out there that are like, whoa, God, what's happening to Meta? It's getting destroyed. And I'm a guy that historically, I have not really been invested in Meta for a while now. But I think about the long case for Meta. And if we kind of take this next leap to fully immersive, fully customizable advertising, like imagine going to an ad and having that video render itself in real time for you with actors or with verbiage that it knows you will personally relate to, because you like to see this type of individual demo a product. You like to see it demoed in this way, and it could render fully immersive ads just for you. Now, we're far away from that because the cost of that compute would be absolutely insane today, all right? But imagine a scenario where the cost of compute comes down dramatically. That is an area we're going to go to. So as soon as the compute gets cheap enough, there are layers and layers of problems and opportunities that will open up to cheaper compute, to basically fill that compute and drive the cost of that compute to a level to where it's balanced again, right? And so if you have an open mind and you don't try to frame AI based purely on a historical mindset of what we experience in our life, because nothing is accelerating. We've never seen anything accelerate like we've seen AI accelerate, right? If you're able to reframe that go off, do some meditation for 5 days, and now think about the future with an intelligence layer, and think about how it changes the way we live, how we think, how we produce products, how we engage with humans and industry. You get into this infinite loop that is not going to last for a couple years, but I think should last for many, many, many years until we're able to find an absolute balance and we're able to kind of like shake out the supply demand. It's really exciting if you think about it, because when you experience that type of advertising, everyone's going to want to deliver that to you. Every bleeding edge product and company in the world is going to want to engage with you in a way that converts 2x higher, 4x higher, 5x higher. And, even if the compute is more expensive, it will actually kind of hit an ROI, right?
Indeed.
So yeah, if you're bullish, that's a reason to potentially be massively bullish on a company like Meta. I'm an Amazon fan, and that also relates to Amazon, who is the third largest digital advertising company on earth. And if you could just envision every single ad on Amazon, right, being immersive, being generated in real time, they're there to play as well. But this is just one model, advertising. You can basically take that and replicate that narrative across almost every single industry sector on earth in a different way. And you could redefine what an industry looks like, how that industry interacts with its customer base. I mean, mental health, for example, so many of us are already using, LLMs for mental health. But I think when we, utilize them for mental health in a fully vertically integrated way, right, to where it's not so rogue that, you might have a psychologist, but you're also using ChatGPT, right?
Yeah.
And then you're going to Hims for your prescriptions, and you're going to Amazon, right? Once you vertically integrate all of that together, and you actually have the ability to now, this sounds like a horrible thing to say, but productize mental health, right? Like for pharmaceutical companies and for the healthcare industry and for insurance, right? I just think it's hard to wrap our head around how far this is going to go. And again, you could make this case for every single industry sector. Oh, I think the most interesting thing right now happening in AI that no one is talking about is that we have millions to tens of millions of humans around the world that are all working 30% to 200% harder than they ever have. If you dig deep and you actually start to ingest conversational data of developers, and you see what has been going on the last 6 to 9 months specifically, you will realize that developers are actually spending more time than they ever have building. Whether they're building for their company and for themselves on the side, these developers are not sleeping because they know the moment we're in. They're able to do 2 to 10x more than they ever have, right, before. Even people that are not traditional coders and developers are able to get in on this game and actually express what's in their head, and actually, build, right? Build themselves.
That prototype cycle is just so much faster now. Anybody who's got an idea at a company can see it throughout to basically production ready, whatever that idea is. So it opens the door for people who had the expertise, the know-how, to actually express and publish it. Thanks.
The incidence of entrepreneurial minds in the world has not changed. We have the same number of entrepreneurial people today that we had 5 years ago. Those people didn't go away. And what nobody understands, because listen, the average person is not a builder and entrepreneur, right? I don't know what the percentage is, whether it's single digits or low double digits of humanity. These people are not going to go away. So when you give them these tool sets, they are going to build and build like you wouldn't even believe. Usually these people hit so much friction and they're so frustrated that they go on with their day jobs and they don't build because they can't build, because there's too much friction. There's too many barriers to entry as it relates to capital raising, as it relates to building out teams, as it relates to risk, because they have families, they have commitments. But now every entrepreneur in the world, every entrepreneurial mind, every builder in the world has been given this gift to build whatever they want to build. And they're just getting started. So the biggest story in AI right now is, what are these people building? What is the world going to look like in 5 years when these 20 million people that are sleeping 3 hours a night right now because they're building with frontier models in their bedroom, they're solving problems, they're basically expressing what's been in their head for 3 or 4 years that they couldn't build, and now they're actually able to take that idea to market to change the world. Right. What will the world look like because of that? How many new companies will we have birthed over the next 3 to 5 years? How many new industry sectors will emerge over the next few years because we have tens of millions of people that cannot stop building? And they never will stop. They never will stop. And all this BS about, hey, we're going to have this intelligence is free, so none of us are going to do any work. That's not how we work as humans.
We're wired to create.
Some of us will. Some of us are going to slack and just chill and, are going to ride the wave of maybe not having to work as hard if we enter any type of age of abundance in the next 25 to 30 years and you're able to basically float. That's fine. Those people have always existed. It's just a different brain chemistry, right? But the builders are going to build, and God, I cannot even imagine what's coming out in the next 5 years, 6 years. So when we talk about where we are in this kind of AI cycle, I'm not even sure if we've gotten started yet. I'm not even sure if we've really seen the start of it yet, because we're looking at existing companies trying to apply AI to solve some additional problems, to cut costs, right? What we're not talking about are the millions to tens of millions of entrepreneurial people around the world that are in the earliest stages of building the next great thing. That's happening, guys. That's happening. And that's the biggest story. That is the number one story right now in the world that no one's talking about. How much compute are they going to need? Right? Like, it's very exciting is all I'm saying. And no one's talking about it.
Yeah. What do you think do you have kind of a profile in your head of the companies that will benefit most from the AI efficiency layer? So like, what are the characteristics of a company that you think will be able to harness AI to grow faster, cut costs, improve margins, and hopefully you improve their stock price over time as a result?
So there's a few different ways to think about this. It's not just one way to take advantage of the AI efficiency wave. You're going to have incumbent companies that are really focused on numbers, right? They haven't really grown all that much in the last 10 years. And they're really looking about how can we become more efficient, right? So companies that have a very high cost structure, any company that has a high employee count of white collar employees that tend to do a lot of a lot of repetitive tasks. So companies that have a tremendous amount of customer service, companies that have just large numbers of repetitive white collar workers. A lot of those companies are simply going to try to chase margins. They're trying to reduce costs because it's a really easy thing to chase once you can figure this out. And I think that happens over the next few years. But there are other companies that are going to look at this differently. They're going to be more aggressive. They're going to say, hey, we can cut cost, or we can repurpose those employees and maybe add to our employee count to start chasing bigger initiatives, to start chasing maybe even a larger number of smaller initiatives that now make financial sense for us. I do think that there will be bumps along the road when the market sees that and they go, wait a second, you're spending more money now, not less. You're keeping your employees and you're spending money on compute. You're now less profitable. So we're going to destroy your stock. And that is a risky proposition for a CEO to take. It's totally different, but similar to what you've seen with mega cap techs going all in on CapEx, spending 120 billion, 200 billion on CapEx.
Raising money even,
Just borrowing debt to simply build out infrastructure for what they see is right in front of their face as an opportunity, right? So think about this. That opportunity is right in front of the face of Meta, of Google, of Amazon, of Microsoft. And these companies are the biggest companies in the world that historically have done a relatively good job. Not all of them, not all the time. Meta's made some mistakes with CapEx, some big ones, but generally have made responsible decisions on CapEx over time. And the market's like, we don't care. We don't like it. It's too risky. We're going to punish you. So what happens when you have hundreds of thousands of smaller companies that are doing more speculative things, right, with CapEx in terms of not laying off employees and spending a lot of money on compute? Temporarily, their margins get hit, but they're like, wait a second, in our industry sector, we're all chasing these things. And if we can get there first, this is the biggest game changer ever for our company. So I think we'll see a lot of volatility. I don't think this is going to be like an up and to the right curve in terms of valuations and market appreciation. I think it'll be a roller coaster. I think a lot of investors are going to freak out over this, the same way they freaked out over CapEx with big tech. And now is the time to really gain a sense of where your conviction lies. How convicted are you in AI, and how convicted are you in the team of the companies you follow to actually make the correct decisions and not simply spend on compute because everyone else is, but actually make these investments because they clearly see opportunity that AI can solve for them. So this is a great time to be a great investor that actually does their homework and is not just chasing the next hot thing, but actually has a high degree of conviction in the various narratives of these sectors and these companies, because there will be amazing opportunities to load up in these companies at prices that are already low for some of these companies and maybe getting a lot lower, right? But the only people with the balls to do that are those that did their homework and really have conviction. Okay, so like, this is why it's such a cool time to be an investor, because there's like literally investors sitting on both sides of every trade. You could look at every SaaS company and half the investor base is like, this is getting destroyed by frontier models. This is going to become a feature of a frontier model as opposed to its own company. And then you have other investors that are like, theoretically, in time, maybe, but not in the next 10 to 15 years, this company is going to cash flow. They have a sticky customer base. They might not be able to grow as quickly, right, as they did before, but they're still going to grow. They're also going to simultaneously cut their cost over time, and they're going to cash flow. And at these stock values, this is an incredible investment. Which side of that do you sit on? I mean, it's a good argument to have, and it's an argument that probably, the winner is different for every company in every sector. So I'm not one of these guys where I'm like, uniformly SaaS is undervalued or uniformly SaaS is getting destroyed. I think there will be companies that do better and companies that do worse. And like, I haven't put the homework in on ServiceNow. I haven't put the homework in on Salesforce and a lot of these other companies to have tremendous conviction in which ones will ultimately be the relative winners and the relative losers. So I think as an investor, you need to be really careful before you just take an opinion on something without doing the homework. Because I don't see a lot of investors doing a lot of homework these days. Like, they're so distracted, caught up by noise. They want to have a position. They want to believe in some thesis. They do a tiny bit of work. They maybe watch someone else talking about it, read a couple articles, and then they act as if they have a lot of conviction in something, which is just themselves fooling themselves, quite honestly.
What does homework look like for you when you really get serious about learning about a company? And, you could use something that you're interested in now, or Amazon. I know you've done quite a bit of work on, and you really are focused on that in terms of exposure to AI in many different domains. But what homework do investors need to do to make sure they understand a company, its prospects, and how it might be impacted by AI?
Well, before I can get to a point where I have high conviction in a trade, I do all the work. And what I mean by all the work is I read all the stuff. I read everything that's been written about that company in the past 6 months. Every analyst report I can get my hands on, every media story. I read every retail investor opinion. I try to read every meaningful, X post. I get into investor chat rooms and I want to get the perspective of everyone. I want to see what the short position is. I want to see what the long position is. I want to know exactly what investors think on both sides of that story, right? I then want to go in and do deep research on every aspect of the business to assess what people are missing, right? Like, I want to understand what the drivers are of this business, and I want to understand, is there anything happening within each of those drivers that people are just misunderstanding or misperceiving, where people are just not seeing clearly, right? It takes between 40 and 70 hours for me to do this on a single company. And towards the end, it gets pretty brutal because I find myself late night, barely keeping my eyes open, desperate to find new information. And that's when I know I'm coming to a close on my research, when I actually cannot find one piece of conversational data, of research anywhere in the world. And by the way, I look at all the alternative data. I pull data. Every piece of data I can pull, whether it's web traffic, whether it's transactional credit card data, whether it's search data, social data, people speaking about their products. I interview store clerks if it's a company that sells their products at retail. There's numerous types of data that you can, aggregate that all potentially touch a company. So I turn over every rock because I don't want to miss anything. I might be wrong in my thesis, but I don't want to be wrong because I missed some information. And when I'm putting 5 to 30+% of my entire portfolio at risk in a single position, sometimes levered, where if I'm wrong, I will lose the entirety of that position. So I might lose, double digits, percentage of my entire portfolio if I'm wrong. I need to know everything. And that's what I do. So it's like, it sounds dumb, but I just read everything. I don't leave anything unread. It takes weeks and weeks to do that.
Are you leveraging AI in any way when you're doing this? I understand that can be both good and bad. You can not, you've trained your brain to look for what you're looking for, but are you leveraging agents to kind of culminate resources, data for you, anything like that, or it's all just manual, you doing searching and stuff like that?
Recently, the past few months, it's heavy-handed on the AI side. I use mostly Codex, and I use agents to essentially help me overturn every rock. Right? I share with Codex everything that I'm learning, my thesis, and it is doing the work alongside me. And it's trying to poke holes in things that I'm not seeing or that I'm missing. So it's been a wonderful partner as a social arb investor. It's like having an entire team. We're just working with you on your timeline, which has just been absolutely amazing. So yeah, I mean, I don't know how you don't use it, quite honestly. It's wild to me. I don't know how you would be in any part of the investment sector and not heavily engage with AI to do nothing other than check yourself and to aid in your research and to aid in your thinking and to kind of play devil's advocate on everything that you do.
Yeah. Chris, I wanted to pick your brain on robotics and where that kind of fits into the larger waves and thesis. Is that part of the AI efficiency where that's kind of taking over a lot of the labor aspect? And where do you see kind of where robotics is now, the timelines of what it could be in 3 years, 5 years, 10 years? Is it kind of on schedule? Because I know, you've talked quite a bit about it in the past.
Yeah, I don't think robotics is going to meaningfully impact any of these sectors in the near-term future. I think timelines are way off. As you know, I'm probably one of the biggest robotics bulls in the world. I think it will be the biggest addressable market in human history when it actually starts to take shape and we start to scale out deployment of generalized robotics across warehousing and industry and, quite honestly, every facet of life. Right. I just don't think that's happening anytime soon. My timelines have always been a little bit further off than anyone else's, and I'm even pushing my timelines back some now. So I think robotics are, I mean, listen, if you're tracking any of the generalized robotics companies, it's not, if you're being truthful with yourself, to realize that everyone's delayed, meaningfully delayed. We haven't seen Optimus, right? Optimus in forever. There's a reason for that. We've seen some videos that have been pretty spectacular, but a lot of these videos that are coming out are, leveraging highly synthesized models to have the robots do things over a short time period that look spectacular, but they're doing it kind of in the same way over and over again. It's not fully generalized. And this is something I think a lot of investors don't fully comprehend. That said, the long-term thesis hasn't changed. I think if we start to move into 2030s, we start to see the signs of what robotics will do. Probably before 2030s. I think if we get into 2028, 2029, investors will start to see enough to where we will reprice certain companies and industries based on what we know is coming over the next 5 to 8 years with automation, generalized robotics, the ability to scale out physical labor without being reliant on an unstable human labor force, right? That doesn't necessarily mean we're going to do away with the human labor as much as it says that the human labor will be in such high demand for more sophisticated use cases that the concept of thinking about human labor to do a repetitive task like this, 12 hours a day, 8 hours a day, whatever it is, for 30 years, is going away, as it should, because humans shouldn't be doing that type of work in the 2030s and beyond. We should think more of ourselves, right? Like, it's easy for us to say, we don't want to, people, like, you don't want to take away those jobs. No, we want to replace those jobs with better jobs for humans, where people get to use their minds more. They get to be a bit more creative. They get to live a bit more of a diverse and safe lifestyle and spend a bit more time engaging with other humans, right? So I'm really excited about it, but it's not part of the early kind of AI efficiency wave that I'm referring to.
Gotcha.
What I'm referring to is mostly just digital, right? It's just in the intelligence layer, but we will see this kicking in the 2030s, and I think we'll start to price it in before the 2030s as well.
To flip the script a little bit, I want to pick your brain as well on kind of the opposite of AI and digital, and like kind of get to the root of like human connection. Is there, because there almost seems like people you want to get off their phones a little bit. They're kind of seeking communities more and more. One thing I'm thinking about is SPHR Sphere, the Las Vegas experience, like that in-person experience that is unique to that point in time. Outside of AI and all that, are you interested at all in these kind of industries where it's more about human connection, in-person experiences, that side of things? I'd love to hear kind of your thoughts on that.
Yeah, this is like my biggest thesis in 2020, actually, which is why I helped launch a traveling Pokemon show called Collecticon that became the largest Pokemon show in the world, that we recently sold to Ari Emanuel and his group, and now they're getting even bigger. It's very exciting. But I spent 5 years deeply engaged with in-person experiences, and there's no doubt in my mind that will be a massive growth industry, not specifically Pokemon or just Pokemon, but in-person experiences. I have restaurants, and for the first time in the last 6 months, I'm seeing more and more people bringing card games to my restaurants and just sitting with each other. They tend not to drink so much anymore, so economically it's not great for my restaurant, but they hang out and they're playing cards, they're hanging out with each other face to face. We're seeing more of that. I think we embrace both. I think we fully embrace where AI is leading us, because it will be very difficult for our brains to say no to that. The immersiveness of being able to do anything in the digital world, especially with gaming. I think we'll see gaming evolve, obviously. We'll see what happens with the new GTA coming out later this year. But I think gaming will become more and more addictive. I think, just engaging in the digital world will become more, unfortunately or fortunately, it will become more and more addictive. But we'll see an equal amount of thirst to get unglued, right? And so I think we'll do both. I think we'll probably see a healthy market for both in-person and, bleeding edge technology as well. I think both will be really healthy. I've had this thesis now, which is my big one around podcasters, right? I think podcasting, I think creators, I think anyone that is meaningfully human, the most human of humans, right? Those of us that are the boldest, the most outspoken, the most fearless and interesting and creative human voices are going to flourish the next 10 years. We will thirst for that. In an age of AI where we can barely tell the difference between what is human and what is AI, we are going to truly learn to appreciate those humans that are most special. The humans that can make us laugh, right? The humans that, we kind of connect to and relate to in a very human way. I think these people will become the rock stars and athletes of the next 20 years, especially when we look at what's happening to traditional media. That world has already blown up. It, for the most part, doesn't exist. It's just in the early stages of an extremely slow death. So if you fast forward 10 to 15 years, I think there are hundreds and hundreds of individual creators who are worth on hundreds of millions of dollars through their media enterprises that they're going to be building over the next decade, because we will thirst for that. I'm really excited about it, actually. I'm building out a podcast studio in Austin. We're launching our first show this fall. I'm launching a new show for me and the Dumb Money crew. We haven't talked about that yet, but it'll be like an in-studio show that I'm wildly excited about. But also, you know, we'll be launching some really interesting shows down in Austin, because I just believe that the most prolific voices out there in the world are not yet being heard because of the friction that currently exists between being a solo creator and, you know, doing TikToks in your bedroom and actually creating a durable medium to where you could regularly engage with the world in a way that you're able to actually build, you know, like a routine voice, right, that people can depend on and count on and build on over many years. And my goal is to help find those human voices and help bring them to the world in a much bigger, scalable way. I'm doing it for the fun of it because, man, when you I spent the last 4 years of my life knee deep in robotics and AI, right? So, like, I myself thirst for more of the human experience, right?
Yep.
And like I had a dinner last night, and it was just spectacular. It was like a 4-hour dinner with a couple guys. One of them I haven't seen in years, and we didn't even drink. Like, we're at dinner, just talking for 4 hours, and this is, you know, I spend dozens and dozens of hours a week alone as a lone wolf, researching data, and conversational data, and investment opportunities, and to get in front of actual humans on a regular basis and just have those shared experiences, it just feels more special today. I don't know, than it did 7 or 8 years ago. Now, maybe we don't do it as much, but when we do it, man, is it great and special. And I love nothing more than listening to my favorite podcasters. I love nothing like, and it's in your pocket, right? It's everywhere you go. It's in the car. You're walking your dog, right? Like, I'm in my closet getting dressed, and like, it's so portable. Media has become so portable. It's really fun. And by the way, I think that's a healthy media too. That's not like you on social media flipping. It's like you actually listening to other humans expressing their thoughts and their feelings. And I just love it so much. And I think we're in the earliest stages of it. So if you are a creative human that feels like you haven't been valued in your life because we've only had one really narrow path to success, you know, if you wanted to be perceived as being valuable in this world or successful in this world, you had to kind of follow this one path to success. And if you were a creative, or you were just an interesting person that likes to make people laugh, right? If all of those skill sets, I think, are going to become meaningfully more valuable over the next decade and a half, because we're about to democratize the intelligence layer. So once you democratize the intelligence layer, all of the other aspects of life become meaningfully more valuable, right? So, you know, I love that. I love that so many people that have been ignored for so long are about to become unbelievably valuable and respected and precious in the new world. Because they always should have been, quite honestly, but our economic model didn't allow them to be, because there was really no way for them to monetize themselves. There was no way for them to like actually validate their specialness in the world, right? And now there is. This is almost like a TikTok moment where you had, for the first time, we were democratizing people that were good at like dancing or good at like these 5 things on TikTok, right? Now, like truly anyone that's delivering any value to any human, outside of just intelligence, which we won't even appreciate much longer, right? Like that's all we've cared about for like all of our life. All we cared about is intelligence, right? Like what are you able of doing? Now, anything you're capable of doing to improve life for any other human will become increasingly valuable. I just absolutely love that.
Perfect. Well, Chris, this has been so much fun. I love hearing your perspective. Any last thoughts for investors and traders out there on key principles that you want them to walk away with today, or just things to think about as they continue to invest over the next year, 2 years, 3-year time horizon?
Yeah, absolutely. If you're an investor right now, leave your screen, leave the market, start with one day. Put your stock app down for one day. Call one friend and say, hey, if we have a market crash and the market's crashing over 3%, call me, okay? I don't want you to look at CNBC. I don't want you to look at your stocks for 24 hours, an entire business day, okay? Just don't think about it. I think you should do that probably minimum once a month. And you have to get out of this habit of living and dying by the success of your portfolio every day. Because if you do that, you will start to doubt yourself. You will see this volatility and you will think that other people see things that you don't see. You'll think that there's something that you're missing and you'll start making ridiculous trades because of that. There's just no reason to do that. Like I spend the majority of my life researching trades, but I'm not looking at the market hardly ever. Like I do look at the market generally every day, a couple times a day. I don't let it concern me. Like I just don't care, because it's like I know now over the course of my career that the market goes up and down for insane reasons on a daily basis. If you really want to be part of that world, and that's going to be your profession, and you want to have an early death, because that's what it's going to do to you, okay? Like if you want to really have your head in this game, because it never ends. The market's really never ends now, right? It's like 24 hours with all the things you can trade. It's weekends. If you really want that to be your life, fine. You're probably young and you want to do it for a few years. I did it. At some point, you have to stop, guys. Okay, you just have to stop. You focus your time on research, live your life, and stop paying so much attention to every freaking move, every article, every rumor, every bit of market gossip. Like it's just, it will destroy you. It will destroy your portfolio. It will destroy your ability to think independently, because you'll be spending way too much time listening to others as opposed to like developing an independent mindset on what you believe is real and important, right? I'd rather have you spend that time in community forums where developers are chatting all day about what they're building in AI. That's valuable. Or if you want to be on the consumer side, which I am most of the time, read comments on whatever the trending videos are across TikTok of what people are buying, what they're wearing, what they're doing, what their time, what their interest level is, where they're traveling, what they're like. That's how you garner real differentiated intelligence that you could then connect dots back to sectors and companies in the market. And you're competing with 99 out of 100 investors are doing none of that. They're just literally getting on X every day and thinking about whatever they're told to think about that day. How are you going to develop an independent thought if you live inside of that world? You can't live inside of that world. You must disconnect from the market. So call a friend, say, hey, if the market moves more 3 or 4%, call me, because you might want to know what the hell's going on, right? And that gives you the peace of mind, by the way.
Yep.
It gives you the peace of mind. Then do not look at any business news that day. Do not look at anything in the market. Do not look at your portfolio. Don't check anything. Just do anything other than that. I promise you, your mental health is going to go through the roof. You are going to be if you can do this once a week, that's gold, right? That's life-changing for an investor. And I say that because this is like a new thing the last few years where every investor is like glued to this 24 hours a day. I can't even imagine. Are you guys like at family dinner, just talking to your kids and wife, if you have one, just about this, because it seems like that's all you think about is this crap, and like it never ends. So it's not healthy, it's not balanced, it's not helping your portfolio. And if I can give investors one piece of advice, I promise you, you will be a better investor if you can figure out how to regularly disconnect from the market minutia and noise. It's not helping you.
Awesome. Well, Chris, thank you so much for your time, for sharing your ideas and thoughts. Really appreciate it. Where can people reach out to you or learn more from you if they want to connect?
Yeah, man, I'm on every channel. I'm on X, Chris Camillo. I have a Daily Clips channel now on Instagram, TikTok, YouTube. It's Daily Chris Camillo. Obviously, we have the Dumb Money Live YouTube show that we try to do every week, but we don't always get one out every week. I'm really active on X, right? At Chris Camillo, but anywhere, guys, like I'm all over the place. So, love to continue the journey. And I love that there are so many retail investors, but just chill out, guys. Everything's going to be fine. Okay? Everything's going to be fine. Don't get caught up in the market on a daily basis. I promise you, you will live a happier life and your portfolio will probably do way, way better.
There we go. A great thought to end on. Chris, thanks again so much for your time. To everyone watching, I hope you guys enjoyed. Leave a like down below if you did. Subscribe if you're new to the channel. And we'll be right back. Cheers.
All right, so that's it for day 4 of the TraderLion conference. Again, a fantastic day of presentations. Let us know in the chat right now, who was your favorite presenter? What was your favorite concept or quote that you heard today? And yeah, just let us know what you really enjoyed from today's sessions. Also, a huge thank you to our speakers. We couldn't do this without you guys. All of them were fantastic. And again, let us know in the chat who is your personal favorite. A few quick reminders again, to get the most out of the experience. First and foremost, subscribe to the TraderLion channel down below. It's 100% free. Then make sure you've joined the VIP pass down below in the description, as well as gone to the conference resource. That's where the recordings, the slides, the guided notes, all of that is stored. So definitely check that out. The link is in the description of the stream, and we'll post in the chat right now as well. Then, as many of you guys did, make sure you're engaging with the chat with others and with the speakers, share notes and key takeaways on X. I want to see a lot of people post today with their favorite takeaways. And then again, you can rewatch your favorite presentations, even on this stream. You just go back in time and rewatch those presentations. A huge thank you again to our sponsors, DeepView, TraderLion, and the Trade Lab. Check out their special offers if you haven't already. And also check out the TraderLion University free resources. We've got model books. We've got the ultimate screening guide. We've got the conference resources from the past and present, beginner's guide to station analysis. So you can learn exactly from Stan Weinstein. All of this 100% free. Just scan the QR code right now, create a free account, and you're in. All right. Also, another conference. Please pay it forward with a donation towards Parkinson's research through the Michael J. Fox Foundation for Parkinson's research. Neither TraderLion or YouTube take any cut whatsoever of your donation. The link is right besides the chat. I believe it should be right below it. And Parkinson's is a devastating disease. It affects, your neurology. It affects not only the person who has it, but also their family and friends. Earlier this year, my grandmother, Grandma Jackie, unfortunately passed away with complications from Parkinson's. She was dealing with it for years. It really impacts your quality of life. And a donation would be a huge help to pay it forward. There's a picture of her with my mother and my aunt as well. Even $10 is fantastic. Again, if you found something valuable from the conference, if you learned something new, pay it forward with a donation towards a great cause. And I'd really appreciate it. So a huge thank you to everybody who's donated already. If you haven't already done so, definitely go ahead and do so. And again, pay it forward. One last mention and reminder to subscribe to the TraderLion channel if you haven't already for podcasts, in-person interviews, tutorials, free webinars, key clips. It's all here. Help us reach 200K. Look down below. If we're not at that mark just yet, make sure you click that subscribe button. Again, it's 100% free. And with that, thanks so much for joining us today. We appreciate you tuning in immensely, and we look forward to seeing you guys back here tomorrow for the last day of the conference. It always sneaks up on me every single year. This has been fantastic already, and we're going to close it out really strong with some excellent presenters. So make sure to tune in tomorrow at 10 a.m. Eastern. And I'll be in touch via email with the links and all of that. But look forward to seeing all of you guys here tomorrow to finish it off strong. So thanks so much. Again, this is my favorite event of the year, and so glad that so many of you guys are also finding a lot of value in it. So again, I look forward to seeing you guys there tomorrow to finish things off. Thanks so much, guys. Take care.